Hi everybody, thank you for checking in. Q here from Hyperstocks. Today we're going to go over the S&P 500 or SPY. This is our weekly check-in and we're going to update the market with what happened last week and what we can expect for the weeks ahead. Last week, the markets ended down for the week, although most indexes hit a record high to start off the week and to start off the year. We saw the S&P 500 in specific finish near the 50-day moving average, which is this blue line right over here. The 10, 20, 50, and 100-day moving averages here are going to act as our supports and our resistance points. Therefore, the 20-day moving average on the top side of this candle is going to act as our resistance, and then the support for the upcoming week is going to be the 50-day moving average, followed by the support at 460 and another support at 456. So going into this week, our main focus is for the S&P 500 is to maintain a level above that 50-day moving average. If it breaks below, then we can see it come down to that 460 mark, and then further on to the 455 to 460, 456 mark. The reason why we're expecting this to happen, or the reason why we use these moving averages as support, is because history shows and historical analysis shows that whenever we come down to the 50-day or the 100-day moving average, we start seeing a supply zone. So people start building up, they're accumulating the position before the market takes off again. Now, when looking into 2022, we covered this in our video about our top picks for 2022. We have to remember how much the market has rallied since the COVID crash and how little this pullback is in comparison to the bigger picture. So when we're looking at overall markets, we're down here, but look how far we've come. So you don't want to overreact during these times. A lot of people have lost a lot of money because they're trying to predict market crashes and market corrections. You really don't know. Nobody really knows. What we do know is that markets often come down 10%. They have 10% corrections every 2 years. So that's not an uncommon outlook into 2022. So we can expect that in 2022. But in reality, what's happening, and which is, if you're really looking at how severe some stocks are getting moved down from their highs, you have to look at individual stocks. And when we're looking at individual stocks, we're seeing Apple in just a matter of a week came down from its $3 trillion market valuation all the way down here. So the companies that are hurting the most in reality are going to be the large cap tech stocks, which the reason why is because they are the ones that out rallied themselves in 2020 and 2021. So when comparing these stocks to companies like Boeing that are, it's more on the industrial side, we see that Boeing is trading a lot lower than Apple and Microsoft are trading at the moment. So what we're seeing in the market is more of a capital and money rotation. So money is coming out of the large cap tech and into the stocks that did not see as much movement in 2020 and 2021. And the reason why that happens is because the analysts, investors, traders, they all see that some stocks are overvalued. Valuation comes into question, and when interest rates going up, when borrowing gets expensive, companies that are trading too high for their own good are going to come down and consolidate for a while. So looking into the following week ahead, we often see markets bounce around the 50-day moving average, in which they attempted to. So depending on how good of news we get, so remember, short-term movement on the stock market is it comes from politics, it comes from news, it comes from short-term announcements, but long-term movement on the market really comes from numbers and valuations. So when we're looking at the short-term movement, the main focus going into this week is going to be the market CPI numbers, or the consumer price index. So tomorrow, which is Monday, the Feds or the Federal Reserve is going to release their expectations for the consumer price index, and then consumer price index is going to come on Wednesday, which is a report that pretty much gauges the health of how consumers feel about the economy. Are they bullish? Are they bearish? Are they kind of pessimistic? Are they optimistic? So that's all that's going to bring us, and it's going to bring us more inflation numbers. So remember, inflation is right around 7.1% right now. So on the consumer price index, which is coming Wednesday, we want to see that improve, but it's not expected to, and that's because of the overall pessimism due to COVID. So All that said, the primary focuses for this week are going to be the consumer price index, and then we're also going to be looking at those companies that have not yet seen that movement. Stop looking so much at the technology companies because they're going to suffer. And what's expected to happen from the S&P or SPY as tech begins to correct, we're likely going to see something come down like this for the first quarter to half a year before we really begin shooting for all-time highs again, because we do need that consolidation that tech stocks drove the S&P 500 so much high from. We need that consolidation before we can take off again. But that doesn't mean opportunities are not there in the market. This is strictly for technology stocks. The rest of the market is going to have the opportunity. You had oil and gas, you have retail, you have heavy industrials, you have machinery, you have farm equipment. All these, industrial stocks, consumer cyclicals, those are going to start moving while technology stocks kind of come down from their highs and gear up for a second trip up. So that's all I have for you guys. I hope you guys enjoyed this video. This is the outlook for the next week and then for the next few weeks and months. I hope this video served you well, and thank you for checking in.